Right, so how about let's take a look at a slide. Okay, we have business cycle. Okay, what is a business cycle? It's the recurring pattern of recession and recovery. Now, for every single business, okay, there's always a cycle. Some companies or some businesses, the cycles are more apparent. For some businesses, the cycles are not that obvious. Okay, so there's always a recession and a recovery, and depending on how long it would take, okay, or how short the recovery would occur. Okay, so here we have the peak. That will be the transition from end of an expansion to the start of a contraction. Okay, and then we have the trough that will occur at the bottom of a recession, just as the economy enters a recovery. Okay, and noticing that this might not be the same pattern for every single business. Okay, some business might have a very long-term continuous peak that will continue to grow until it will reach a platform, okay, where there's no future growth anymore. Then it will start with a decline. Okay, so in the most general cases, a business cycle, if there's a recession and recovery, we can expect to see a figure or a pattern like this. Okay, it could be a fixed pattern, a regular pattern, or an irregular pattern. But for a managerial point of view, a regular pattern is better than a irregular pattern, because this way, for a firm and also for analysts, okay, we can estimate and we can forecast the likely future profit of a firm. Right. So with the business cycles, we have cyclical industries and defensive industries. Now, if it's a cyclical industry, it will definitely have some pattern in the business cycles. So there's an above average sensitivity to the state of the economy. When the cycles are actually sensitive to the economy, it means the economy is booming and normal or declining. The cycles of the industry will change accordingly. Okay, so example, producers of durable goods such as automobiles, or producers of capital goods or high beta stocks, it means that they're highly risky. Like what we mentioned earlier, the tourism industry, okay, that they tend to have a very apparent or very obvious business cycles during the peak season and the trough seasons, okay, right. Now, how about for the defensive industries? This is what we call the defensive industries, that they're not sensitive at all to the economy, because most of these defensive industry will include utility, okay, or the food producers or pharmaceutical, because these will be the daily necessity, okay, the necessary goods and services that we need on a daily basis that can help us to operate on a daily basis. So here it is little sensitivity to the business cycle. Some example, we have food producers and processors, okay. We have pharmaceutical firms. For example, hospitals are always open during the holiday season. They have no vacation, no annual holidays. Okay, so it has to be open on a daily basis. Okay, public utilities will be the same. Okay, telecommunication, there's no holiday season for that. Okay, natural gas, okay, or petroleum, they're always open. Okay, 24 hours a day, and 365 days a year, right? So in terms of this, for defensive industry, the likely risk will be lower and the performance will be quite stable, okay? So in terms of investment, if you're looking for high return, high risk, cyclical industry with obvious business cycles will be your choice. But if you say, I'm looking for somewhat more like a fixed income industry, that you'll be very happy just to receive fixed dividends, then defensive industry might be your choice. Okay, low risk, low beta, and the performance is actually quite stable, right? So that's the difference between cyclical industry and defensive industries. Now, how about for economic indicators? We have leading economic indicators, coincident indicators, and lagging indicators. For the leading indicator, these will be the indicator that will show the first sign of the economy, and then all the other indicators will follow later. Okay, So the economic series that tend to rise or fall in advance of the rest of the economy. Like what we mentioned earlier, the stock market index. Because the stock market index is entirely established, a very big part on market expectation from investors, either from individual investors or institutional investors. So the stock market index will tend to have a very strong part coming from investor confidence or investor sentiment on how they feel about the future economic development. Then they will decide how they want to trade or the strategy that they have for the stock market investment. Now, coincident indicator that will move with the market. Okay, we'll talk about that later. And we have lagging indicators that will change subsequent to market movements. And as a matter of fact, when the lagging indicators show, that will be really the sluggish economy will occur, the slowing down of the economy, and there will be a huge decline because it will take a long time for the lagging indicators to show. And then in order for the general public who are not investing in the financial market to feel the downturn of the economy. Okay, even though if they're investor, they might have felt it when they participate in the stock market. But for households who do not participate in the stock market, they won't feel the declining or the changes of the economy until the lagging indicators start to show or start to appear, okay, such as the unemployment rates. Right, so let's take a look, okay. Part A, we have leading economic indicator. Some of them will be the average weekly hours of production worker in the manufacturing firm, okay. Noticing that manufacturing industry is the most important industry that will support the economic development of a nation, right? Initial claims for unemployment insurance, definitely, okay. If you're unemployed, most governments will provide you with some insurance to help you to get through the period that you are not employed or you are temporarily unemployed. Simply because of the termination of your employment contract, or you have some accident that might have caused you to stop working physically, okay, or mentally, right? And we have manufacturers' new orders, okay, consumer goods and material industry. This is extremely important. That will show the signs of market demand, okay, market demand, all right? And because there are strong signals from market demand, market supply coming from manufacturers' orders will be relevant, okay, and in order to match up with the market demand. Now, number 4, we have fraction of companies reporting slower deliveries, okay. That will also be a very negative leading indicator because firms are not able to deliver on time, okay, and that might signal a problem in the production process, okay, whether it's machinery, whether it's labor, whether it's increasing cost, okay, or simply because of unavoidable factors such as extreme climates, okay. If I'm doing international trade, but the extreme climate is causing damages to my freight and to my merchandise, then the delivery will be negatively affected. Okay, new orders for non-defensive defense capital goods, okay, and new private housing unit authorized by local building permit, right? We don't just build houses, okay? We have to have permits from the local government. And the new houses, if they want to be built, it has to be able to meet with the market demand. And the real estate market is creating market demand, okay, by introducing new houses. And they will encourage people to buy new houses rather than staying in one house for 20 or 30 years, even though the mortgage is scheduled for 20 to 30 years. And then we have a yield curve slope. Okay, that will be a 10-year treasury minus the federal fund rate. Stock prices, of course. For the 500 common stocks, we have money supply M2 growth rate, index of consumer expectations. Right, so in part B, we have coincident indicators, okay, that will be occurring at the same time with economic development and industry cycles. Such as we see the employee on non-agricultural payrolls, okay, how much are they getting paid, and how quickly are they getting paid? Are they paid on time, with a delay, or some advancements for the payroll. Okay, and we have personal income, less transfer payments. How much of the transfer is being made out of personal income? Okay, and how much is left? Okay, for the consumption and for the consumption purposes. And we have industrial production. Industrial production is actually very closely related and moving together with the economic development because of market demand and market supply. Okay, and we have manufacturing and trade sales. Also, that will go hand in hand with industrial production. Now, part C, we have lagging indicators. That will be the average duration of unemployment, ratio of trade inventories to sales. Okay, for the unemployment, this is critically important because firms usually do not make the decision for unemployment immediately. Okay, it will usually wait until when the firm judges that there's no future economic development in the short term or in the long term. Okay, then the unemployment decision will be made. Okay, and usually that will take a long time. Changes in index of labor costs per unit of output, average prime rate charged by banks, of course, commercial and industrial loans outstanding, ratio of consumer installment credit outstanding to personal income, and change in consumer price index for services. Okay, so all these will be examples of the leading economic indicator, coincident indicators, and lagging indicators. Okay, and this will be coming from the Conference Board Business Cycle Indicators as of November 2012.